Hello students, this is Vaibhavi, your teacher, and today we are going to learn international economic institutions, changing face of International Monetary Fund, recent developments. Over the period, the role and functioning of IMF has changed significantly to with cope up with new challenges which emerged during the last 5 decades of its working. The significant stages are as follows. A. Par value system. The countries that joined the IMF between 1945 and 1971 agreed to keep their exchange rates, the value of their currencies in terms of the US dollar, and in the case of the United States, the value of the dollar in terms of gold, peaked at rates that could be adjusted only to correct a fundamental disequilibrium in the balance of payments, and only with the IMF's agreement. This par value system, also known as the Bretton Woods system, prevailed until 1971 when the US government suspended the convertibility of the dollar and dollar reserve held by other governments into gold. B. End of Bretton Woods systems era of free float. The Bretton Woods system based on par value of the currency in terms of gold faced a serious crisis between 1968 and 1973. In August 1971, the US President announced the temporary suspension of the dollar's convertibility into gold. But these attempts could not lead to restoration of the old system. Since 1973, the major currencies began to float against each other. Now, the IMF, International Monetary Fund, members are free to choose any form of exchange arrangement they wish, allowing the currency to float freely, pegging it to another currency or a basket of currencies, adopting the currency of another country, anticipating in a currency bloc, or forming part of a monetary union. 2. C. Oil shocks. The price suddenly started going up in October 1973, resulting in oil price shock to many oil importing economies. The IMF responded to the challenges created by the oil price shocks of the 1970s by adapting its lending instruments to help oil importers deal with anticipated current account deficit and inflation in the face of higher oil price. It set up the first of two oil pool accounts. D. Debt crisis and helping poor countries. The oil shocks of the 1970s, which forced many oil importing countries to borrow from commercial banks, and the interest rate increases in industrial countries trying to control inflation lead to an international debt crisis. During the 1970s, Western commercial banks lent billions of recycled petrodollars, getting deposits from oil exports and lending those resources to oil importing and developing countries, usually at variable or floating interest rates. So, when interest rates began to soar in 1979, the floating rates on developing countries' loans also shot up. E. End of communism. The fall of the Berlin Wall in 1989 and the dissolution of the Soviet Union in 1991 enabled the International Monetary Fund to become a nearly universal institution. In 3 years, membership increased from 152 countries to 172, the most rapid increasing since the influx of African members in the 1960s. In order to fulfill its new responsibilities, the International Monetary Fund staff expanded by nearly 30% in 6 years. The executive board increased from 22 seats to 24 to accommodated directors from Russia and Switzerland, and some extending directors saw their constitutions expand by several countries. Role of International Monetary Fund. The International Monetary Fund supported its membership by providing various types of assistance required by them. It includes policy advice, research, technical assistance, and loans. A. Policy advice to governments and central banks based on analysis of economic trend and cross-country experience. B. Research, statistics, forecasts, and analysis based on tracking of global, regional, and individual economics and markets. C. Technical assistance and training to help countries improve the management of their economies. D. Loan to help countries overcome economic difficulties. Concessional loan to help fight poverty in developing countries. Organizational and management of International Monetary Fund. The International Monetary Fund is led by a managing director who is head of the staff and chairman of the executive board. He is assisted by a first deputy managing director and two other deputy managing directors. The management team oversees the work of the staff and maintain high-level contacts with member governments, the media, non-governmental organizations, think tanks, and other institutions. A. Managing Director. The Managing Director is the chief of the operating staff of the fund and shall conduct under the direction of the executive board the ordinary businesses of the fund. B. Executive Board. The International Monetary Fund's Executive Board is responsible for selecting the Managing Director. A. Board of Governors. The Board of Governors is the highest decision-making body of the International Monetary Fund. It consists of one governor and one alternate governor for each member country. The governor is appointed by the member country and is usually the Minister of Finance or the head of the central bank. The Board of Governors also elects or appoints executive directors. The voting by the Board of Governors usually takes place by mail-in ballot. The Board of Governors of the International Monetary Fund and the World Bank Group normally meet once a year. During annual meeting, governors consult with one another and present their countries' views on current issues in international economics and finance. Every 2 years, at the time of the annual meeting, the governors of the bank and the fund elect executive directors to their respective executive boards. B. Ministerial Committee. International Monetary and Financial Committee and the Development Committee are the two ministerial committees to advise International Monetary Fund Board of Governors. The IMFC has 24 members drawn from the pool of 185 governors. Its structure mirrors that of the Executive Board and its 24 constitutions. As such, the IMFC represents all the members countries of the fund. The committee discusses matters of common concern affecting the global economy and also advises the International Monetary Fund on the direction its work. The Development Committee is a joint committee tasked with advising the Board of Governors of the International Monetary Fund and the World Bank on issues related to economic development in emerging and developing countries. The committee has 24 members. It represents the full membership of the International Monetary Fund and the World Bank and mainly serves as a forum for building intergovernmental consensus on critical development issues. See, the Executive Board. The International Monetary Fund's 24 members executive board takes care of the daily businesses of the International Monetary Fund. Together, these 24 board members represent all 186 countries. Large economies such as the United States and China have their own seat as at the table, but most countries are grouped in constituencies representing 4 or more countries. The largest constituency includes 24 countries. D. Governors Reform. Managing Director Dominic Strauss-Kahn appointed in September 2008 a committee of eminent persons to assess the adequacy of the International Monetary Fund's currency framework for decision making and advise on any modification that might enable the institution to fulfill its global mandate more effectively. The 8-person committee, chaired by Trevor Manuel, Minister of Finance of South Africa, reported its finding in March 2009. Lending by the International Monetary Fund. Regular lending facilities. 3 main purposes of lending. Article 1 of the International Monetary Fund's Articles of Agreement states that the purpose of lending by the International Monetary Fund is to give confidence to members by making the general resources of the fund temporarily available to them under adequate safeguards, thus providing them with opportunity to correct maladjustment in their balance of payments without resorting to measures destructive of national or international prosperity. Today, International Monetary Fund lending serves 3 main purposes. A. Lending for shock adjustment. First, it can smooth adjustment to various shocks, helping a member country avoid disruptive economic adjustment or sovereign default, something that would be extremely costly both for the country itself and possibly for other countries through economic and financial ripple effects known as contagious. B. Lending to increase the confidence of investors. Second, International Monetary Fund programs can help unlock other financing, acting as a catalyst for other lenders. This is because the program can serve as a signal that the country has adopted sound policies, reinforcing policy credibility and increasing investors' confidence. C. Lending for preventing crisis. Third, International Monetary Fund lending can help prevent crisis. The experience is clear. Capital account crises typically inflict substantial cost on countries themselves and on other countries through contagious. The best way to deal with capital account problem is to nip them in the bud before they develop into a full-blown crisis. Condition for lending. When a member country approaches the International Monetary Fund for financing, it may be in or near a state of economic crisis, with its currency under attack in foreign exchange market and its international reserves depleted. economic activity stagnant or falling, and a large number of firms and households going bankrupt. The International Monetary Fund aims to ensure that conditions linked to IMF loan disbursement are focused and adequately tailored to the varying strength of members, policies and fundamentals. To this end, the International Monetary Fund discusses with the country the economic policies that may be expected to address the problems most effectively. The International Monetary Fund and the government agree on a program of policies aimed at achieving specific quantified goals in support of the overall objectives of the authorities economics program. For example, the country may commit to fiscal or foreign exchange reserve targets. 1. The standby arrangement. The standby arrangement is a key lending facility established in 1952. Although its use has been declining in recent years, it has remained the most popular facility for middle economic countries that seek financial assistance. Under its structure, financing is provided in support of adjustment to a balance of payments need and disbursed in tranches based on conditions spelled out in the program. The International Monetary Fund's largest loans have traditionally been provided under standby arrangements. 2. Flexible credit lines. The International Monetary Fund has introduced a new flexible credit line for countries with very strong fundamentals, policies, and track record of policy implementation. Once approved according to preset qualification criteria, countries can tap all resources available under the credit line at any time, as disbursement would not be phased and conditioned on compliances with a traditional fund supported program. This is justified by the very strong track records of countries that qualify to the flexible credit line, which give confidence that their economic policies will remain strong or that corrective measures will be taken in the face of shocks. The establishment of the flexible credit line represents a significant shift in delivering fund and financial assistance. 3. Extended fund facility. The extended fund facility is used to help countries address balance of payments difficulties related partly to structural problems that may take longer to correct than macroeconomic imbalances. A program supported by an extended arrangement usually includes measures to improve the way markets and institutions functions, such as tax and financial sector reforms, privatization of public enterprises, and steps to make labor markets more flexible. 4. Emergency assistance. The International Monetary Fund also provides emergency assistance to countries coping with balance of payments problems caused by natural disasters or military conflicts. The interest rates are subsidies for low income countries. Special drawing rights. Special drawing rights. The special drawing rights was created by the International Monetary Fund in 1969 to support the Bretton Woods fixed exchange rate system. A country participating in this system needed official reserves, government or central bank holding of gold and widely accepted foreign currencies that could be used to purchase the domestic currency in foreign exchange market as required to maintain its exchange rate but the international supply of two key reserve assets, gold and the US dollar, provide inadequate for supporting the expansion of world trade and financial development that was taking place. Therefore, the international community decided to create a new international reserve asset under the auspices of the International Monetary Fund. However, only a few years later, the Bretton Woods system collapsed and the major currencies shifted to a floating exchange rate regime. In addition, the growth in international capital markets facilitated borrowing by credit-worthy governments. Both of these developments lessened the need for SDRs. The SDR is neither a currency nor a claim of the International Monetary Fund. Rather, it is a potential claim on the freely usable currencies of IMF members. Holders of SDRs can obtain these currencies in exchange for their SDRs in two ways. First, through the arrangement of voluntary exchange between members, and second, by the IMF designated members with strong external position to purchase SDRs from members with weak external position. In addition to its role as a supplementary reserve asset, the SDR serve as the unit of account of the IMF and some other international organizations. A basket of currencies determines the value of the SDR. The value of the SDR was initially defined as equivalent to 0.88,671 grams of fine gold, which at the time was also equivalent to $1. After the collapse of a Bretton Woods system in 1973, however, the SDR was redefined as a basket of currencies today consisting of the euro, Japanese yen, pound sterling, and US dollar. The US dollar value of the SDR is posted daily on the International Monetary Fund website. It is calculated as the sum of specific amount of the four currencies valued in US dollars on the basis of exchange rates quoted at noon each day in the London market. The basket composition is reviewed every 5 years by the executive board to ensure that it reflects the relative importance of currencies in the world's trading and financial system. In the most recent review in November 2005, the weights of the currencies in the SDR baskets were revised based on the value of the exports of goods and services and the amount of reserves denominated in the respective currencies which were held by other members of the International Monetary Fund. These changes became effective on January 1, 2006. The next review will take place in late 2010. B. The SDR interest rate. The SDR interest rate provides the basis for calculating the interest charged to members on regular, non-concessional International Monetary Fund loans. The interest paid and charged to members on their SDRs holding and the interest paid to members on a portion of their quota subscriptions. The SDR interest rate is determined weekly and is based on a weighted average of representative interest rates on short-term debts in the money market of the SDR basket currencies. C. SDR allocation to IMF members. The International Monetary Fund may be allocated SDRs to members in proportion to their IMF quotas, such as an allocation provides each member with a costly assets. However, if a member's SDR holding rises above its allocation, it earns interest on the excesses. Conversely, if it holds fewer SDRs than allocated, it pays interest on the shortfall. There are two kinds of allocations. D. General allocations of SDRs. General allocations have to be based on a long-term global need to supplement existing reserve asset. Decision to allocate SDRs have been made three times. The first allocation was for a total amount of SDRs 9.3 billion disbursed in 1970-72 in yearly installments. The second allocation for SDRs 12.1 billion was disbursed in 1979-81 in yearly installments. The third general allocation was approved on August 7, 2009 for an amount of STRs 161.2 billion and will take place on August 28, 2009. The allocation would mean a simultaneous increases in eligible members' SDR holding and in their cumulative SDR allocation by about 74.13% of their quota. A special allocation of SDRs. A proposal for a special one-time allocation of SDRs was approved by the International Monetary Fund's Board of Governors in September 1997 through the proposed Fourth Amendment of the Article of Agreement. Its intent is to enable all members of the IMF to participate in the SDR system on an equitable basis and correct for the facts that countries that joined the fund after 1981, more than one-fifth of the current IMF membership, have never received an SDR allocation. This allocation would increase members' cumulative SDR allocation by SDR 21.5 billion using a common benchmark ratio as described in the amendment. The Fourth Amendment became effective for all members on August 10, 2009, when the fund certified that at least three-fifths of the IMF membership, 112 members with 85% of the total voting power, accepted it. On August 5, 2009, the United States joined 133 other members in supporting the amendment. The special allocation will be implemented on September 9, 2009. We are buying and selling SDRs. IMF members often needed to buy SDRs to discharge the obligation to the IMF, or they may wish to sell SDRs in order to adjust the composition of their reserves. The International Monetary Fund acts as a broker between members and prescribed holders to ensure that SDRs can be exchanged for freely usable currencies. For more than 2 decades, the SDRs market has functioned through voluntary trading arrangements. Under these arrangements, a member and one prescribed holder have volunteered to buy or sell SDRs within limits defined by the arrangement. In view of the expected increase in the volume of transactions following the 2009 SDR allocation, the number and size of the voluntary arrangements is being expanded to ensure continued liquidity of the voluntary SDRs market. In the event that there is insufficient capacity under the voluntary trading arrangement, the fund can activate the designation mechanism under the mechanism Under this mechanism, members with sufficiently strong external position are designated by the fund to buy SDRs with freely usable currencies up to certain amounts from members with weak external position. This arrangement serves as a backstop to guarantee the liquidity and the reserve asset character of the SDR. Thank you.